Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. Markets are always confusing and seemingly unpredictable. That is what makes them markets, the attempt at price discovery, and the ascertainment of risk versus reward. However, the current market environment is particularly unpredictable and therefore treacherous. I thought as we enter the period that is so often referred to as the Santa Claus rally, we would spend some time revisiting some of the market charts on our desk at metasii.com to see if our stockings will be pleasantly filled or full of the Grinch's coal. As such, I hope to cover the items listed here. Let's start with why the current market expectations will be wrong, as they most often are. Remember, markets tend to extract the maximum amount of pain, confuse the most amount of people, and normally reward contrarian thinkers. Earlier this fall, we did a three-part series on our market expectations, as well as one of the ways we expect the Federal Reserve would extract itself from the trap it has clearly got itself into. We went through a lot of detail and charts in these videos that led to the conclusion we would see the markets enter a stage of heightened troubles by the end of October, early November. This is exactly what has in fact occurred, and almost right on time, maybe about 3 weeks later than our videos suggested. In the video entitled "A Central Banker's Escape Route," we showed this concluding thought experiment slide. The idea was we knew the markets were entering this period. That was an insurmountable fact to us, and it suggested it would be a high-risk period at minimum. However, until we actually entered into it, we couldn't be sure exactly what form it would take. The truth is there are too many variables that make any projection highly risky. It has been our experience instead to prepare for that period with its probabilistic outcomes and then let the markets tell us what to do next. Be nimble, and like a sailor, trim your sails to adjust to the wind, the current, and the goal you are after. Simple, right? That is why our thought experiments show two unfolding patterns overlaid here: an impulsive 5 count leading to a long-term structural sell-off, or a possible corrective 3 count before heading to new market highs. We aligned those counts to match what we saw as the most likely movement in the markets based on past similar historical patterns and current support levels. In these presentations, we were very clear that credit would lead the way, and unless we saw it breaking down significantly, none of this would occur. The degree to which credit broke down to us would tell us just how much damage and structural impact to expect. We showed this high yield or junk bond chart, amongst others, that we specifically felt you should carefully monitor for confirmation and severity in the area we labeled watch for deterioration rate. So where did all this take us today? Time for an assessment. Well, here is that same chart and what has unfolded as of last week. Credit is clearly breaking down, as predicted, and at a fairly fast pace. We have a lot of evidence of credit deterioration as we watch other factors such as serious delinquencies over 90 days by loan type. However, we're not yet where we want to be to make a definitive decision. There are many reasons for this, which we will get into in a moment, but it goes back to the point we made earlier when we said markets tend to extract the maximum amount of pain, confuse the most amount of people, and normally rewards contrarian thinkers. Markets historically don't crash on fear. We're at extreme fear, as this chart shows. Something is screaming, at least in the short term. Therefore, our updated thought experiment has pulled in its horns slightly to suggest the near-term market movement, though likely to be highly volatile, will likely deliver a shallower short-term downward movement. At least that's what it tells us so far. It also says we do not have confirmation that an intermediate to longer-term top is in. What we have so far is what we term a volatile consolidation. We don't have yet what we call a market correction. We have no technical violations of yet, which we'll show in a moment to show we're actually achieving or going through a market correction. Thirdly, we don't have any indication that the market trend has in fact reversed. New market highs in the short, intermediate, and longer term are still on the table. Only the risk of a trend reversal has actually increased with the volatility and credit deterioration levels we're currently seeing. So let's dig a little deeper to see what we should be watching for to get better clarity. Hopefully, this will allow us to continue to be fully prepared for what is now unfolding. The red wedge shown here on the S&P 500 going back to the bottom of the 2000 COVID market sell-off has not been broken. We have not yet seen any real technical damage, as I've said. Volatility, yes. Technical damage, no. We have simply only tested the 100-day moving average, which has contained all prior consolidations but one, and that is contained within the unbroken wedge. As they used to say on the Carnival Midway games, no cigar here. This similar daily chart highlights what we have done is depart from the black trend line, which has been acting as a very good trend support since the COVID low. You will notice that during this run-up that momentum and the advanced decline line indicated at the bottom have divergent trends with the S&P, a sign that this rise is not in fact healthy. That doesn't mean it won't continue in either the short term or the intermediate term. It certainly says there's questions in the longer term. On a longer term weekly chart, we see we have been held by the 20 weekly moving average. We also see that the relatively normal cyclical pattern lows have yet to be followed. I would draw your attention to the black expanding wedge. On the right upper side, it now approximates the 80 weekly moving average. We'll come back to that, but it is firm support for the market at approximately 4,000 on the S&P 500. The signals we also suggested you follow closely in our three-part market series is revisited here. In red, we highlight what we conclude so far. In the short term, we have a volatile consolidation, at least so far. We are seeing lower lows and lower highs, the beginnings of a trend, but not necessarily a confirmed trend yet. Yes, the counter rallies are extremely strong, but the drawdowns are likewise heart-stoppingly strong. We're seeing wave counts in both directions, which Elliott wave parlance are both impulsive and corrective. We have market turmoil without a clear tradable pattern yet being seen. What is going on here is what we laid out in our recent video. It's the gamma mem strategy, stupid. We also wrote a number of newsletters as well. The markets are dominantly under the control of the options market and the gamma theta players. Our newsletter on trading in Tesla specifically in their options laid out the details of how this stock was taking the entire market with it in both directions. If you haven't seen this video or read the newsletters, I suggest you study them closely to know what you're actually up against. The art of war tells you that if you don't know both yourself and the enemy, you're almost certain to lose. Frankly, it has forced us to further upgrade our systems to incorporate spot gamma data points as shown here in red with horizontal trigger lines and tables. Our detailed hourly charts leave little doubt what is going on. The detail as you drill down can be a little overwhelming, but has helped us be on top of why we had a low on Friday, circled in red, then saw us violently move upward to the red circled price point by Tuesday close. A 200-point S&P 500 move driven by options readjustments. We also witness how the massive MEM day trading crowd reacts to timed spot gamma data releases, while the pay-for-flows trading houses have the data well in advance. This is a new world running on a highly leveraged naked call and put writing that the public has no ability to compete with, nor to understand, and is best left to the trading bots calculating theta decays in real time. What we suggest you do is stand back and try and identify key pivots which our MATA SII charts continue to identify and update. Charts that give you a tradable investment trend for both short-term swing trading, intermediate position trading, and long-term trend following. Our concepts of high probability trading zones, or what we refer to as HPTZs, and trigger levels are more important than ever to understand. We have a book out that explains all this, which can be purchased at our site or from Amazon. So what concerns us the most right now? There are many issues to be aware of. Here are some important ones. As we mentioned earlier, markets historically don't crash on fear. 10 days ago, the market absolutely hated puts. The level of hate, in fact, was at its longer-term low. Last week, the money poured into puts at a rate higher that we haven't seen in 2 years. Money that just went up in smoke. with the 200-day counter rally move since Friday, which I just showed you. These sort of swings are unprecedented and are a signal of increasing levels of instability that can and often does get out of control quickly. I'm also concerned how the markets are reacting to and trading credit itself. Though they have been weakening significantly in line with our expectations, they're trading like meme stocks. In anticipation of what we expected, we updated our high-yield bond charts to give more granularity to any downward pressures. We added 100, 200-day moving averages, along with further support lines and proprietary exponential moving averages. What we witnessed is that when the 100-day moving average was approaching a 200-day moving average cross, what is referred to as a death cross, and prices had been below those levels, the computer algos calculated the point of cross and then front ran prices down to the gray support line. That in itself is no real surprise, as that is how computer-driven algos work and how the markets are traded today. What surprised us is that as the cross was going to happen, circled in red, the market spiked the bond prices down, that is yields up, to just above our much lower support line, shown in black, but not quite there. Then in 2 days spiked it almost the entire drop back towards a death cross with huge daily opening gaps. This is not normal in credit markets, nor in the bond markets, where we saw the 10-year yields drop from 1.53 to 1.34 and then back to 1.48 in a couple days. You need to fully appreciate that these sort of changes in bond and credit volatility have profound value at risk, or what is called VaR regulatory ramifications for institutional holdings. This also can quickly lead to market instability. We are also concerned about the dramatic movements in corporate stock buybacks. 40% of the bull market we've been experiencing for years now has been due solely to corporate buybacks. Corporations have been big buyers of the recent dip. Inflows, in fact, were seen at $6.7 billion, which were the largest last week since 2017, and as a percentage of U.S. market cap, the largest since last December. This is despite serious concerns about pending U.S. congressional legislation that, if passed, will increase corporate taxes and add new regulatory burdens, in addition to 2022 slowing sales, earnings, and cash flow projection estimates. What's up here? These are huge numbers, which are about to suddenly be halted because their open window for 2021 ends on December the 10th. How is this going to impact the expected seasonal year-end Santa Claus rally shown here, based on data averages from 1985 to 2019, or the normally high January follow-through? We've also yet to see the market begin to price in shrinking Federal Reserve liquidity and an accelerating advancement of tightening through rate hikes. Yes, the Fed is still buying bonds, but markets price out 6 to 8 months and react to the rate of change, not the absolute amounts. The market is yet to react to this and price it in. The market is so dependent on the current levels of global liquidity, it is hard to imagine it can continue to ignore the realities of this, as well as the mounting pressures of all central banks beginning to fight inflation head on. Powell, in congressional testimony, broke recently with Fed speak when he stated that inflation is not going to be transitory. How does a market shrug off such a massive shift in thinking without more than a normal consolidation? It doesn't happen that way, typically. I don't think the flattening of the yield curve is getting sufficient attention either. I also don't think the yield curve has begun flattening significantly, as shown in the pink box on the upper right. Market sell-offs have historically occurred as the yield curve initially surged, as shown by what occurred during the dot-com and financial crisis sell-offs, highlighted on the left. What we have is a bear flattening, shown here in the red box. This is the end of the cycle that started with the 2020 COVID crash and the yellow box's bull flattening. The recovery has run its course, as has a decade-long business expansion cycle. Inflation will pressure yields higher. At the same time, slowing growth will pressure them lower. This is called stagflation. This is also not typically good for the markets. If all this sounds confusing, that is because it is. Short-term market directional trend decisions are presently a crapshoot. But that will change suddenly, and the direction will be clear. That is when you make your move, not before. Anticipate what may come, as we're doing here, but only invest when it is confirmed as happening. To react sooner is at best speculation, and worse, as just simply outright gambling. Short-term trading with widespread gamma trading to us is basically a robotic killing field for the unprepared and those not highly automated. This is not investing. The current odds of success are poorer than the odds you get at a regulated casino. We have a very mixed set of important intermediate signals shown on the left. Our proprietary macro signals on the right currently reflect the following: a recent short-term shift to the buy side, followed by market difficulties in the first half of 2022, but longer term, more or less after the U.S. midterm elections, going up from there. You can see by the dates that most all changed lately, with the exception of the longer term, showing the markets headed higher, despite all the warnings we just went through. But that's longer term. Clearly, the markets just don't believe the policy setters any longer, and they know they will be forced to keep expanding liquidity at ever greater rates. And that's why I believe they're not adjusting yet. That doesn't mean we won't get a violent correction before it goes higher, because there's a whole generation or two who know buying the dip is the proven strategy for success. That is not something that is easily changed. That mentality, especially when there's close to best estimates of 500,000 young millennials and people under the age of 31 who are trading stocks full time from their mother's home or in their apartment. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems, until such time as no one will take that money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. Powers to be are now effectively trapped, but they're trapped by policies of fiat currencies, unsound money, political polarization, and global paralysis. Maybe the better way of saying it is they are very limited kinds of traditional options available to them. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been actually a better time for investing. However, it requires careful analysis and not following what has traditionally been true and tried approaches. Do your reading. Make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2021 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.